Hi, my name is Bruce Boldrin. I'm the founder of the Enterprise Engagement Alliance, and I'm hosting this show today with Dr. Solange Charas and Stela Lupushor, who are going to focus on one of the most critical parts of the Enterprise Engagement Alliance curriculum, and that is the new field of human capital management. And I'm going to let them tell the story. So rather than even explaining that, I'm simply going to explain who our guests are today. Dr. Solange Charas is founder and CEO of HCMoneyball. It's a human capital analytics company that enables companies to literally create human capital reports in alignment with ISO 30414 human capital reporting. And she's also an adjunct professor at 3 major universities on human capital, helping develop a whole new cohort of students who understand this critical field. And Stela Lupushor is a expert in the whole area of people management. And in fact, she has written now 2 books, and one of them is with our guest today, Solange Charas, and their book, Humanizing Human Capital, is actually part of the formal training and certification program that comes with Enterprise Engagement Alliance. So if you want to call yourself a stakeholder capitalist, we consider this new book coming out to be must reading. And Stella's book on the right there of your screen, obviously is a very timely book. So Stella, I wanted to tell good folks about that. And finally, we always want to thank our partner solutions, the companies that help our clients and our audience make enterprise engagement happen. And finally, all of the great resources, many of which are free. We're developing new libraries and expanding libraries to really enable companies get to work at profiting from a strategic and systematic approach to managing stakeholders. So I'm now going to stop my share, and we're going to focus now on our guests. So Solange, let's start with you. Please feel free to introduce yourself just a little bit more and tell us, how do you define human capital management and why does this matter?
Thank you, Bruce. I'm delighted to be here and especially to partner with Stella. We spent about 1.5 years collaborating on the book, and it's always a sheer joy and pleasure to be in her company and to hear her creative and innovative thoughts. So thank you for having both of us on. I could talk about how I got to this space forever, but I think probably it will suffice to say that I didn't want to be a human resources or a human capital person. I actually got my MBA in accounting and finance with a minor in taxation, which is not your typical background for an HR person, and came to the field really by accident. But that financial literacy has served me well in my 30+ year career. And now I am an advocate, an apostle, proselytizing that human capital people actually understand financial terms, financial impact. And as we go through this program, both Stella and I will speak to how important it is to quantify the impact of human capital management and human capital itself, worker productivity, on sustainable corporate or enterprise level outcomes. So most HR people are really focused on the effectiveness of HR programs, and they measure effectiveness by understanding how HR programs achieve those key performance indicators attenuant to those programs. And we make a distinction between people management or people analytics and human capital analytics, which is basically connecting the dots between human capital performance and enterprise level performance. And in a little bit, I'll explain or describe some new research that was just published where you will firmly understand why this topic is so critical and important. So that's
and before we move on to Stella, one other thing. A lot of people in HR object to the use of the term capital. They say, why do you, well, I'm a people, I'm a human being. Why are you calling me capital?
Well, let me address that for just a second, and then we'll turn it over to Stella to introduce herself, and she can also address it through her lens. back in 1996, when I first started working for Arthur Andersen, the field was migrating from being called personnel to human resources. And Arthur Andersen likes to credit itself with being the first institution to refer to human resources as human capital. And the reason we made that distinction is because a resource is something that you use up, like you use lumber or you use water or you use ink, right? It's something that is depleted or used up in the production of something valuable. We felt back then in 1996 that people aren't just something that you use up. It's actually capital like investing in real estate or investing in a building, that you make an investment and then that investment pays off over the long term. So I know that some people object to that thought of themselves being thought of as capital, but that's actually a good thing because it's something that organizations invest in, not use up.
Well, that's great.
We like to think about that way.
So Stella, well, just to get that thought, one more thing, go ahead.
Sorry. The other reason that it's important to think about it as capital is because the SEC about a year and a half ago reclassified human expenditure, human spending, not simply as an expense, but rather an investment in an intangible asset, as if you were investing in capital. So it's human capital is really now a term of art in the management space. Most financial people, most regulatory people, most CEOs will refer to it as human capital, not human resources. It's just the HR people who are still referring to it as human resources. So
well, very interesting cultural situation. Stella, so please quickly introduce yourself beyond what I've said, and why does this matter? And maybe in a sense, have we viewed people as a resource? Maybe it's actually true, your view.
Absolutely. So my name is Stela Lupushor. I do consult. I am teaching as well. And I have a big belief in using the data for to humanize the work environment. I do think we have seen for the past couple of years this change in relationship and social contract between employers and workers. And it's not that it wasn't there, it just accelerated. And it's another evidence of how workplace practices need to adapt to the modern expectations of the workforce. We no longer can treat people as resources. And yes, we have been treating them as resources because we were always assuming that we have jobs and we can make people replaceable and interchangeable if we know how to describe what needs to get done and then have a way to price it out. And we've seen that it's impossible to use the same practices going forward because the way workers are relating to the work environment is changing, the way they expect to be treated is changing, the way organizations are finally awakening to the fact that workers is one of the most important part of the value chain creation. The more we need to look at the workers as individuals, and I'm intentionally using the word workers as opposed to employees, because that's a lot more inclusive. We have non-traditional workers, we have digital workers, all of those kinds of workers are participating in performing the work, right? So the more holistically we can describe what that is, and the more we can design the work environment and the work experience in a way that creates a equitable, inclusive experience for everyone, the more we will be able as a business to thrive in the long term, because people will bring their full potential, they will bring their talent, they will show their loyalty, they will recommend us to other consumers or other workers. So it creates a virtuous cycle, but it requires a lot of adjustment to how we perceive the workforce and how we engage and create that experience for them in a positive way.
Well, then, Stella, that leads to a question that I can pose you, and then I'm going to put it back to Solange. Really, is a question for both of you. I think CEOs have begun to wake up to this, and Solange can talk a little bit more about the pressure coming from investors. And now you are talking about this attitudinal change among employees. Are our CEOs really trained to deal with this? It's not taught at Harvard. It's not taught anywhere.
Yeah.
The whole issue of managing people holistically, strategically, and systematically is inconsistent with the concept of, no offense, Jack Welch, to this whole concept that everybody is replaceable and that we're all, essentially a resource. Are our CEOs prepared for it? And is it, and this is going to be the same question for you, Solange, and do they understand the economics at stake?
I think they're starting to grasp that. And on one side, you hear all of this hope of leaders that, well, with the economic downturn upon us, hopefully people are going to stay put for a little longer. But I think there's a misconception that you can still manage in the same command and control, more hierarchy driven, more productivity driven, and replaceability concept. I think Solange and I both are in academic world just because we feel that there is little education about the impact of the human capital in the context of work environment. And we need different kinds of measurements. We need different kinds of practices. And we bulk a lot of this due to the measurements, right? If we have tangible assets, we can put an accounting system in place. We can put a financial system in place. We can track. We can create KPIs around that. A lot of the work products and output that the workers, especially knowledge workers, are created, a lot of it are intangible, like employee well-being, employee experience, the health and safety that we create. All of that is kind of squished, a little bit less easily quantifiable, and therefore we're not going to measure, we're not going to track, we're not going to hold anybody accountable. So that's how we end up in this situation. But I think with the evolution and growth of the human capital analytics practices and a lot more quantifiable way to demonstrate the value of the workers, we are now getting into that space where leaders and investors and different stakeholders are starting to demand more accountability and more transparency. And once you have measurements in place and have a baseline, you then can call people and hold them accountable, or put in place changes that could impact in a positive way those outcomes. Solange, I'm sure you have a
well, that's a great segue to what I wanted to ask Solange to fill out on this. Solange, something you like to say, and I quote you often, I can't tell everybody every time that it was Solange, but most CEOs are driving with one eye on the road, aren't they? And isn't it really much like total quality management? I'm going to be the only one who's going to claim superiority here in age. And I was there at the dawn of the total quality management revolution, and there were all these buzzwords and talk and everything, total quality circles. But we were building 10% inefficiencies into our manufacturing model, into our business model, and it was just built into your model. And then the Japanese came along with total quality management, and of course, dramatically changed market share. We were forced to change. Solange, are we building massive inefficiency and even unhappiness into our business models?
That's a really interesting question. And let me reference something that I just heard. I just got off a call with somebody, and they are fully committed to the fact that there's going to be a major recession, and not because of the underlying economics. They believe there's going to be a recession because companies are going to drive a recession so that they can get control over the workforce. So it's very strategic. Companies are now realizing, based on what happened in COVID and the ensuing Great Recession, that they no longer have control over the unit of input to a business model called labor. And that is a big part of a business model that until now has basically gone unexamined because there was an abundance of labor in the market. And if somebody quit, you could easily find a replacement. And now what we're finding is that organizations are not able to fill their open jobs. There are 11 million open jobs in this country, and companies are having a hard time filling those jobs because it is a buyer's market with the employees being the buyer. They are choosing who they want to work for, when they want to work for them, how they want to work. And companies are beginning to resent this, that they are losing control over the input labor. And this person said companies are going to force a recession so that they can gain control again over labor. So companies are going to do mass layoffs, right? So that they can create a labor pool that will take a job, which I think is a little nutty. And what I said to them is, well, why would you cut off your nose to spite your face? Companies don't want to be in recession. They want to be in expansion and growth. So why would they bring this on? And she said, because it's not an economic decision, it's an emotional decision. So when you,
I don't want to digress too much into that. I think it's it's a symbol of the times and the frustration is true.
yes.
To allege that there's that much of collusion, well, that's another story. Maybe there is, but it's an interesting point, and I've heard the same thing. CEOs are very frustrated, but getting very frustrated at every level. So
Right.
Small companies, big companies. But getting back to your point here, this does drive why there's a smarter way to deal with it, right? A smarter way to deal with it rather than forming collusion and driving a recession. Isn't it to manage well? And isn't it that why investors are basically, didn't this come from investors? Really?
Yes. So you're absolutely right. And that's what Stela and I talk about in the book, which I think Stela is going to address a little later, is there are some fundamental assumptions that are being made about labor as the input into the business model. And you can't continue to rely on those old assumptions because the world is different, right? It's that old thing, you know, I can be the best buggy whip maker in the world, but I'm still not going to sell any buggy whips because there's no market for it. So we need to raise the awareness to leadership that you can't keep doing the same old and expecting a positive result. That's what Einstein said, right? Doing the same thing over and over again and expecting a different result is the definition of insanity. And I think that that's where we're going to see the biggest change is in the assumptions around labor as a input into the business model. And organizations that are already adapting to a new reality are the ones that are going to emerge with their competitive advantage. Now, that's internally looking, right? That's from the inside out. What's going on from the outside in, which is what you said, what's happening in the investor community, what's happening with the other stakeholders. So investors are only one stakeholder. Yeah. We have employees, we have communities, we have vendors, we have customers. I think the two biggest shifts that are happening, apart from employees, the labor part of the equation, is that consumers are basing their purchasing decisions on human capital issues. And the two biggest issues that consumers consider before purchasing a company's product is, do they treat their employees well in general? And the two issues that they look at are DE&I and pay parity, pay equity. So if companies want to keep their consumers, their customers, they need to disclose this information about how well they are treating their workforce. So that's number one. The second is, and we have evidence from the conference board that, you know, supports these observations. It's not just me, you know, sitting in my little apartment, not going out because of COVID, dreaming these things up. We actually have research underneath it. The second is the investor itself. And there are a couple of things that are important to understand here. Investors are getting very smart about human capital as a driver of economic value creation. And they are demanding more disclosures in this area, which is essentially why the SEC a year and a half ago said, if human capital is material to your organization, meaning that it moves the needle and would impact the way an investor would either buy, sell, or hold your stock, you have an obligation to disclose that information if it's material, right? If it has an economic impact. And we're seeing that pre-disclosure requirement, about 40% of organizations already disclosed something quantitative about human capital. Post this regulation, 73% of companies are actually providing quantitative information about human capital performance. And that's just in their 10K filings. The big companies, the smart companies, the disclosure forward companies are actually creating ESG reports, environmental social governance reports that are not required by the SEC, but they're voluntarily disclosing things about their employees. So we're seeing more disclosure. We're seeing that there's an article that just came out last month that was written by 3 Columbia Business School professors and 1 Harvard Business School professor. So 4 professors did research. The article is called Regulated Human Capital Disclosures. And what they're finding is that there is a statistically significant and substantive relationship between human capital disclosures of these 2,000 public companies that they looked at between 2018 and 2022. And their market value, that those organizations that are disclosure forward, especially around quantitative impact, actually have improving or increasing market value. What does that mean? That means that investors are investing in companies that are transparent about human capital. And that is huge. This is the first time we've had some real significant longitudinal information about the relationship between human capital performance and disclosure and market value. Now, we know this intuitively because Ocean Tomo did a study and said that 90% of the S&P 500 market value is based on intangible assets and human capital is intangible. But this is the first time we're seeing that direct and statistically significant relationship. You want your stock price to go up, you start disclosing about human capital.
Well, I want to use that to get to Stela again. And the interesting thing about that study that we featured, by the way, folks, on our own media platform today as a lead story, is that they only found that correlation in companies where there's a high input of human capital. In other words, it's when companies like a Costco. And in the old days, Costco would have been punished every time they announced a pay increase, and the stock price would have gone down. So Stela, you look at this with your own fresh perspective, right? And everything you talked about, of course, I would agree with. But the question is, do you think that the pressures that both you Solange have mentioned from different stakeholders, because consumers are also investors, right?
Yep.
And if 40% of them, 50% of them care about how companies treat people. If community like Amazon was not able to get favorable tax treatment in New York because they weren't liked. And that might have been a big mistake on New York's part, who knows, but they weren't liked. So do you think that the pressure is significant enough that boards are going to start looking for CEOs who know how to manage stakeholders strategically?
Boards absolutely are starting to look at this, and we see an increase in representation of heads of HR, so people with HR training that can be part of the conversations and help shape some of the culture issues, some of the workforce and workplace treatment issues, because there is a recognition that you cannot limit only the executives' compensations decisions to the board. You really need to get engaged and more proactive in how organization is creating that experience, how the culture is shaped, because culture will, or the side effects of bad cultural traits will show up in terms of fraud, in terms of dissatisfied customers, in terms of certain, accounting discrepancies, all of that. And we've seen plenty of examples over the past decade of how organizations that are pursuing bottom line returns at the expense of all the other stakeholders, at the expense of ethical behavior end up on the front page of the Wall Street Journal. So it's becoming more of a employment and company corporate brand issue, and it has to be managed from the top down, because that's where the direction is set. That's where the role modeling happens, and the stakeholders are not just investor community that the bottom line, but also about the long-term stability of the organization. But it's the communities where organization has presence and contributes to taxes and employs and creates good jobs. It is the supply chain that we've seen how fragile it is if you optimize it only for efficiency. You have to create that little slack in the system. You have to enable people to adopt and have not only a stable employment and living wage, but also have an environment where their mental health is not impacted just because they have to cope with their day-to-day activities. They have to fill in for everybody who quit or everybody who is sick out. You have to cope with more demands from the consumers who are demanding more, faster, cheaper. So all of these pressures show up in the mental health, in the abilities to be productive. And there's a point in time when people say, I'm out of here. I cannot deal with this. And companies have to then deal with projects they cannot deliver on, with commitments to the customers they cannot deliver on. So it becomes a bottom line issue ultimately for organizations, and boards, of course, are starting to pay attention to that.
But so now, Solange, then, haven't we built this into our business models? And if so, what are the implications? What do we need to do to respond to this? What does the CEO need to do to address? She said a strategic and systematic approach. We're not doing it. We're still the same old thing. Oh, we're going to do a recognition program, put out an RFP. Oh, let's do a wellness program. So we're going to get into the metrics in a few minutes. To actually let the CEO know what, the Japanese taught this country what quality management meant. They could see it. And by the way, it took us 10 years, but we got our market share back in many requests. Well, I take that back. We forever lost our domination, but at least we got ourselves back into the game. So Solange, how do companies need to respond?
Yes. So before I get there, let me just make a little comment on boards. Human capital has become such a hot board issue that the prevalence of board directors with HR experience has spiked recently. So board directors are now checking the box. I have HR experience.
Isn't that a problem based on what you said?
It's a huge problem, because just because you have managed others doesn't mean you are a human capital expert. And people who are on boards or recruiting for boards need to be very vigilant about making sure that you are not having human capital represented by somebody who just has a lot of management experience. Just because you're a manager doesn't mean that you know HR or human capital. That's what Stella and I do at our universities. And by the way, she teaches at NYU as well.
I didn't know that. I'm sorry, Stella.
We are preparing the human capital professional for the future to not just be a people manager, to actually understand the utility and the cost benefit and the financial implications of designing, executing human capital programs for the organization. So just be aware of the fact that there's a lot of human capital experience inflation amongst board directors. That be smart when you look at that.
Well, in other words, we're getting more diversity theater in a way. Oh, we're going to need DEI, so we put an African American, put a woman. So yes, folks, right. Listeners, don't just check off the box. But then what are the other strategic implications?
So human capital management is different than just being a manager, and we haven't had up until the last several years a way of quantifying that approach. So in finance, we actually are able to measure the ROI of every investment we make in the company. In operations, we're able to measure quantitatively our productivity, our, error rate, our ROI of our supply chain, even marketing, which was for years and years considered to be a soft and intuitive practice, now has concrete measures associated with the ROI of marketing dollars invested. Sales has always been pretty easy, but now in human capital, we are beginning to apply the same kind of data rigor to human capital as we have to every other function in the organization. And what's really surprising to me is how few people really understand what this means. I mean, I talk to guys in the private equity world and I say the phrase HCROI, human capital return on investment. And they go, what's that? I've never heard of it. You talk to a CEO, HCROI or HCVA, human capital value add, or HEVA, human economic value add of human capital. They've never heard of these phrases. We've been studying this in the academic community for 50 years, and it is a concrete way to understand the economic value creating impact of our investment in human capital. So,
okay, stop right there. Stop right there, because that's going to lead into Stela and then your next question. Because what I'm going to ask you in a minute is to literally go into the metrics that every CEO should know today that will prove your earlier point that 50% of them, and I'll say 80% of them, are driving with one eye on the road. So hold on to that thought, because you're going to end with that pretty much, other than a quick update, because we're watching the time here. So Stela, this concept of looking at our employees and our workers, okay, on a lifetime basis, okay, in the past, and that, that would be a warm and fuzzy, again, another door closer with the CEO. Yeah. Another program check. Oh, we'll do a life cycle there. But when we hear the economics of all of this from Solange, which is why I wanted to hold it off till the end, okay, tell us about this concept of the life cycle. And people hear about job design, and you have to do this quick.
Yes.
But again, people need we need to move away from talk to action. So how can we look at workers in a lifetime way to create a more productive and quality relationship with them?
If we think about consumers, how the definition of what a consumer is and how we create that experience for them, right? That shift in mindset of businesses being maniacally focused on consumers and looking at their end-to-end journey from the moment where they wake up until they make that purchasing decision. That's what helped create new leaders, transform industries, create new sources of value. The same kind of thinking is time to be brought to the world of work. And traditionally, we think about employee experience from a HR process lens. We say there is a talent acquisition process, there is compensation, there is payroll, there is benefits, and a lot of systems, a lot of actions and programs are being designed around the HR processes. We're not thinking about what it's like to be a worker from the moment where you get up in the morning, you show up for work, you try to log into the system, your password has expired, you try to reset, it takes forever to reset it. The systems don't talk to each other. By the time you're ready to be productive and do what you need to do, it's lunchtime, right? We have optimized for consumer experience, but if you're a worker and do not know what a good experience looks and feels like, you'll have a really tough time delivering that to the customer. So there is a direct link between the two, and the thinking is not along the HR process definitions and progression, but along the employment journey, and can start from the moment where a person doesn't know anything about you as a company, then they discover it, and be that through internships, or they are an investor, or they are a consumer, until they decide to bring their talent in whatever capacity that is, employer, employee, supplier, contractor, until they go through the hiring experience, they become a worker, they get developed, they get engaged, they get benefited, they get coached, they get inspired, even until they decide to leave, they still have a relationship. They may recommend to work at the company or not. They may still be an investor or not. They may come back as a boomerang employee. The more we can think holistically about that end-to-end life cycle, and then think, where are the positive interventions that we can put in place to maximize whatever the value exchange between the organization and the worker is? Because at the end of the day, it's a trade-off. I give my time, I give my effort and talent, I get paid, or I get benefits, or whatever that exchange looks like. So how can we make it fair and equitable between the two?
Well, and so my thinking when I hear that is, if I'm a CEO, I'm thinking, my gosh, if I'm going to do that, there'd better be an ROI. So Solange, this is now your time. And remember, we only have 8 more minutes, so we have to be careful here, because I do want you guys to at least tell us a little bit about your book, because it is part of our formal curriculum. Solange, what are the metrics that every CEO should know, that securities analysts should be asking them for at their quarterly meetings, and that they should be managing their business to?
Right. The most important, and I think the most indicative, is human capital return on investment, HCROI. It's like anything that you invest in your business, you want to get a return on that investment. And, you buy a piece of property, you want that property to give you a return on investment over time. You sell something for a profit, that's a return on investment, right? You can measure it in financial terms. We measure ROE, return on equity, ROS, return on sales, ROA, return on assets. So we are accustomed to understanding a return concept. And in human capital, the thinking was always, oh, that's a sunk cost. What I spend on people for salary, wages, retirement benefits, training and development, recruitment, everything that I spend on people is really a sunk cost. It's not. You're investing in something that should give you a return. And for 90% of the companies out there, and I'm excluding 10% where human capital really isn't a driver of economic value creation, like a REIT, right? Where your value is assets under management. People are going to be instrumental to generating sustainable value for the organization. And you should be able to measure your human capital return on investment, the return that you get on every dollar that you invest in people.
I'm watching your time. We need the other way.
Getting
By
there.
the way, folks, you can get the calculations by Googling them. You just
Right.
Google it. So go ahead, the others.
We actually have a HCROI calculator, so that all you have to do is put in 4 or 5 different pieces of information that are easy to get, and it will not only show you what your current HCROI is, but what a 5% improvement in that would generate in terms of profitability. And for most organizations, it's anywhere, 5% improvement will generate a 30 to 40% lift in profitability if more than 50% of what you're spending in total expense goes to people. So it has to be leveraged. We did some research, Stella and I did some research at the conference board, and what we found was that organizations that are actually using human capital analytics, so I'm going to get back to that humanizing human capital theme,
Yep.
Companies that are actually using human capital analytics to understand human capital performance and making decisions based on data and business insights have an HCROI that is close to 3 times higher than organizations that don't use human capital analytics. That's the difference in our study, the difference between a $7.30 return for every dollar invested in people, which sounds pretty good, right? I give you $1, you give me $1, I give you $7.30 back in a year. Sounds great. But the good companies, the companies that are using data analytics, are getting a $19.25 return on investment. So would you rather get $7 back or $19 back on the dollar that you invest? That's a no-brainer.
Now tell me then, because again, we have time issue here. Just quick, 4 other, because I've read, 4 other critical indices that a CEO who's human capital oriented Human
They
capital ROI, human capital value add. How about revenues and costs and willingness to refer of employees, revenue costs, willingness to refer of customers,
Right.
any
So
DEI?
there are two types of measures. There's the macroeconomic measure, which takes in all of human capital investment and basically indicates whether or not that your investments in people are generating a positive return. And then there are program level. So should we invest more in training? Should we change the way that we recruit? Should we offer a referral bonus? Those are program level that have their own ROI indicators that maybe a CEO doesn't want to look at. He wants to look at the overall aggregate. And what the aggregate metrics tell you is how that tracks with other financial outcomes. So do we see a relationship between HCROI and profitability? Do we see a relationship between HCROI and asset growth, right? Do we see a relationship between HCROI and net promoter score? So we're looking at human capital's contribution to a strategic outcome. And that's what boards and CEOs should be looking at.
So that's that you would say, again, I'm only cutting you off because of time,
Yeah.
the major then two measures from a CEO standpoint. Again, I remember from some of your work, I was very intrigued by that revenue, cost, profitability of an employee, of a customer, and the willingness to refer. I judge that by having, I think every company should have a referral program personally, because I don't think there's any better measure of engagement.
That's true. It's an interesting way of understanding how well your employees like your company. What we would recommend looking at are things like HCROI, which we've talked about, HCVA, human capital value add, so the amount of profitability attributed to employees, HEVA, human economic value add, so there's a formula underneath that. That's pretty easy to calculate. And HCMV, human capital market value, which only works for public companies because we're comparing market value to book value and understanding employee contribution to that spread, because we want market value to be a lot bigger than book value, right? So there are some real top line macroeconomic indicators that CEOs and boards can use to track over time performance. Don't look at it in one period, look at it over several periods, quarter by quarter, year by year, month by month. And another big one is employee productivity, the contribution that every employee makes to top line revenue. So those are the
Solange, I'm watching the clock. We're going to put a track to your a link to your HCROI calculator in the footer and the description to this show. So thank you. So Stella, in wrapping up, the new book that you and Solange, in a nutshell, why is this going to be so important for our listeners? Why do you think we made it part of our, you join, you get your book. Tell us quickly about it.
It is giving not only the stories, the context, but also the formulas and recommended measurements. So it's very well at balancing the requirements and the needs, the market needs and the drivers for change, but also practically, here's how you approach it. Here are the examples of how you measure the success of whatever changes you're making. Some of the concepts are somewhat counterintuitive, and therefore it requires a little bit of an example. Like we have in the book 20 principles that we structured along the employee life cycle, the worker life cycle. And one of them is
for that real 1 second.
We do. So I want to share just one example.
That'll be our concluding.
Yeah.
Great.
So hire for a career, not a job. Many times we hire a person to fit a specific job requirement, as opposed to saying, what is the initial need for people to be able to be successful in this job, and how might we create that experience for them to grow and evolve with us as an organization. And for each of these principles, we have a story, we have the list of measurements that can be used to support and examples of the types of changes to programs, HR programs, as well as employee experience changes that are needed to leave that principle in practice.
Well, thank you both. And by the way, if executives need one example today of the power of people, they look to look no further than the Ukraine, because we are seeing a tiny little country standing up to a world power, still staying up. Why? Because of the incredible engagement of the people, all of the people, the men and the women, the children. And so every CEO, I beg you to look, are your people willing to fight for your company like the Ukrainians are willing to fight for their country? And I say probably not in most cases. I thank both of you for joining us. And secondly, I want to make the final point that you, Stella, are a great example of what the other solution to our problem is. It's called opening our borders to talented, wonderful people who want to come here, and workers, because we need all of them. And we are non-political, we are nonpartisan. This has nothing to do with politics. It's all about good business. And to have you come to this country, it's a loss for your homeland, but it's a gain for us. So thank both of you for this great program. And this will be running for a full year as part of our formal education program. Thanks again for joining us today.
Thank you for the opportunity to
Thank
be here.
you.